Oh, so you think time is your ally? I was born into the wheel, molded by it. I didn't see negative theta until I was already a man. Hey everybody, Walrus here from Walrus Street, and today I'm going to be bringing you volume 2 of my options theta wheel series. Today I'm going to be covering about 7 vocab words that I think you guys should know and understand in order to find some success with the theta wheel. Now the first couple words are going to be really easy, and then we're going to get into the dreaded Greeks. Not all of them, just a couple of the ones that are relevant for theta wheel. So first up, we have got strike price. Now the strike price is also known as the exercise price, and this is simply the set price that the option can be bought or sold at. Usually the strike price is seen in 50-cent increments. Party in the club, bottles full of bub, and I'm gonna stop right there. Second word is going to be premium. The premium is the market price of the options contract. Now there's a relationship that's important to understand with options. As days to expiration increase and as IV increases, premium increases. Now we're gonna define days to expiration IV in a moment, so don't you worry yourself about that one. Premium is going to reflect the extrinsic value of out-of-the-money contracts, and this is going to be our covered calls on the second cycle of the theta wheel. Premium reflects the extrinsic and intrinsic value of in-the-money contracts, and this is going to be our cash secured puts of the theta wheel. That's going to be our first part of the cycle. The next word, very simple, days to expiration. Usually you see the abbreviation DTE. This is the number of calendar days remaining until the option expires. A lot of people confuse this one with the number of trading days, but this is actually the number of calendar days. So if you buy an option at close of trading on Friday, it expires the following Friday, it's a 7 days to expiration option, not a 5 days to expiration option. So please don't confuse that. Also, when you look at the option chain or the option ladder, however you decide to phrase it, for different commodities, different equities, different assets, they don't all have the same number of options available. A lot of them only have higher days to expiration options, and this has to do a lot with the volume of interest in that stock, the open interest. So that's not really something we're going to be dealing with, but you're going to see when I'm choosing my stocks, choosing stocks with options that have 5 to 7 days to expiration, that have basically options expiring every week, is going to be something that I'm shooting for. The next word is going to be implied volatility. Implied volatility expresses the magnitude of a stock's price movement. Implied volatility is something I like to think of as stability. Now, if we think of a low beta stock, something that's not super correlated with the S&P 500, something like Coca-Cola or Johnson & Johnson. Coca-Cola and Johnson & Johnson have lower implied volatility than meme stocks, something like GameStop and AMC, or something like a biopharma company that is about to have a binary event. So when we're looking at implied volatility, just understand I like to see this as stability. Now, options are priced with implications of future volatility. So if you have a low beta stock, there's low implications of future volatility, so it's going to have a lower premium, a lower price associated with the option. When you're trading options, I think it's really important to remember that you're actually trading volatility. Volatility is one of the most important aspects of options, buying and selling both. IV is non-directional, and all it's showing you is the likely spread in a percent of the movement of the price of the underlying asset. I like to think of it as kind of like the Weather Channel's hurricane cone. You know, they're not really sure where it's going to hit in a week, so they give you that wide range of possibilities. Or maybe some of you guys see the spaghetti plot with everything all over. A couple notes about implied volatility. Note number 1, there are 3 circles of implied volatility. The first circle is event volatility. This is going to be associated with any news out of the company, any PR from the company, or, you know, stuff about the CEO, announcements, that type of thing. Earnings reports are big causes of event volatility. Circle number 3, I can't count. Circle number 2 is going to be your non-event volatility. This is going to be your everyday volatility. This is like the normal vol of the stock in the trading of the market. And then number 3, I got it right this time. Number 3 is going to be your overall market volatility. So if you choose stocks that are low beta or negative beta, which is really tough to do, but if you choose stocks like that that are not very correlated with the market, then market volatility plays less and less and less of a factor. And that's something that I am going to be shooting for with a lot of my my stocks that I'm choosing for the wheel, I'm gonna be looking for low beta or low correlation stocks with the market. Note number 2 about implied volatility is that there's actually 2 types of volatility, and nobody really talks about both of them. We have implied volatility, which is like the future movement, the implied future movement of the value of the underlying of the option, but we also actually have realized volatility. So realized volatility is past and it's looking backward. And it's actually important because realized volatility adjusts implied volatility. So if you have a stock, if you have an underlying asset that has not been moving very much, and at once it was very high IV and then the movement just kind of plateaued, the realized volatility, everything that's saying, hey guys, the price isn't moving, the price isn't moving, the price isn't moving, that's going to adjust the IV down. So we've got people that care more about the IV, obviously, because when you buy something, you're looking towards the future. Options are future looking. So IV is the one that everybody talks about, but realized volatility is also important. Now, this brings us to the dreaded Greeks. The Greeks would be coming from the Black-Scholes-Merton BSM model, which is going to be the ubiquitous, everybody use it, derivative options pricing model that was created in 1973. And the Greeks are the variables that are found within this pricing model. There's first order Greeks like theta, delta. There's second order Greeks like gamma. There's even third order Greeks, and those would be terms like color, but at that point, we're not even using Greek letters. Can they really be considered Greeks? Begone, thought Xerxes. Get out of here with your false Greeks. The first one that I want to talk about, and I don't want to cover all of these today, I just want to talk about the ones that are relevant for the theta wheel. So the first one is delta. Delta is going to be our hedging ratio, and this is a first order derivative of the underlying asset's price. So delta is going to be a ratio, a decimal less than 1, comparing the change in the asset price with the change in the derivative or the option price. A couple notes about delta. Note number 1, delta can be a positive or a negative value. Delta of calls ranges between 0 and 1, and delta of puts ranges between 0 and -1. So we've got positive for calls, negative for puts. Now, for an example, in a vacuum, assuming nothing else changes, if you have a delta of 0.75 and the underlying asset's price increases by just $1, that means the option price is going to increase by 75 cents. So as an option goes further and further in the money, delta is going to be approaching 1. The second Greek that I want to talk about is going to be gamma. Now, gamma is a second derivative of the underlying asset's price, and it's a first derivative of delta. And holy crap, are we here for a calculus lesson? No, I don't think so. So let me go ahead and simplify this. Gamma is expressing the rate of change of the option's delta per $1 move in the price of the underlying. To make this even easier, let's use the physics example that literally everybody uses. Since gamma is expressing a change of a change, I want you to think of delta like the speed a vehicle is traveling, and gamma is going to be the acceleration of the vehicle. So we've got gamma expressing the rate of change of a change. Now, a couple notes about gamma. The first one, gamma is going to be largest when an option is at the money, and it's going to decrease to 0 as options go in the money or as delta goes to 1. Long options have a positive gamma, short options have a negative gamma. Next note, reducing gamma actually reduces your alpha, and we know that alpha is our market edge. I mean, there's an entire website called Seeking Alpha, clever name, guys, where they're looking to beat the market. I don't want you to think of gamma as necessarily a bad thing. We actually need gamma. We need to accept some gamma risk in order to beat the market, in order to obtain that alpha that we're looking for. So if a stock has a higher gamma, don't automatically avoid it. We actually need to accept some risk there. Vega is another Greek, and I'm going to kind of skip this one because I'm going to be running mostly weekly options on my wheel. I'm going to be selling weekly puts, weekly covered calls, and Vega plays a very small factor there. I think with Vega, as long as you understand that if an underlying asset has a high IV, then you're going to see a higher premium, that's a good enough understanding of Vega, and we could just skip it and move on. Now, the last of the Greeks, the big one, the whole purpose of the theta wheel, let's talk about theta. Theta is also known as time decay, and this is going to be another first order derivative. Theta represents a decrease in the option's value over time, and it's recalculated daily. So theta is expressed as a negative number since the passage of time decreases the time value. Note number 1, theta is going to lose value as the option approaches expiry in a vacuum. Again, we have to look at everything in a vacuum. vacuum. So assuming the price of the underlying is not changing, assuming the IV is not changing, theta is going to lose value as that option approaches expiry in a vacuum. Note number 2, theta is really good for sellers, but not so good for buyers. And this is the power of the theta wheel. Because we're going to be selling cash secured puts until eventually we get assigned, and then selling covered calls until these shares get called away, theta is our biggest ally. We're going to be profiting from theta this entire time. Now, this is because value is going to decrease from the buyer side and it's going to increase from the seller side as time elapses. I want you to think of it this way. If you're buying an option, you're fighting two different enemies. You're fighting time and you're fighting the general market, sentiment, and that's everything that can go with trading. But if you're selling options, time is on your side and you're actually only fighting the market. And I know that's still a pretty big thing to be fighting, but time is your ally. Oh, so you think time is your ally? I was born into the wheel, molded by it. I didn't see negative theta until I was already a man. I'll be signing autographs after the video. Now, last note about theta, selling options is going to be a positive theta trade. And also I want you to remember that theta and IV have an inverse relationship. So as IV increases, theta decreases and vice versa. Theta is going to be, like I said, such a powerful ally as an option seller with time on your side. Theta decay actually ramps up approaching expiry. It's a non-linear thing. So we have an increase in outcome likelihood with the passage of time because simply there's just not enough time left for IV events to happen. Now, to use a football analogy, I want you guys to think like you're playing American football. Sorry, not European football. I'm talking about, you know, the one that we play in America where we hit each other. What do you guys call it? Hand egg? I think you call it hand egg. So I want you to think that you're playing hand egg and your team is up by 18, fourth quarter, 2 minutes remaining. The other team has the ball. So they get the ball, no timeouts. They have 2 minutes. They got to cover 18 points. What do? 2 touchdowns, 2 two-point conversions, 2 onside kick conversions, probably a long field goal. Is the likelihood of that happening very high? Absolutely not. That would be miracle of miracles. And that's why theta decay ramps up closer to expiration. The outcome likelihood becomes more and more certain. Also, in that analogy, I want you to realize that you're already winning. And that's because part of the strength of the theta wheel, if you do your market research, if you pick a strong underlying stock, you're putting yourself in a good position. You're setting yourself up for success. And I mentioned this in yesterday's video, but choosing the correct underlying is perhaps the most important part of the theta wheel. All right, everybody, that's it for today. In the next video, I'm going to be talking about how to choose your DTE, your days to expiration for your theta wheel strategy. Thanks a lot, everybody. I hope you did enjoy the video today. As always, if you want to support the channel, please check out my Webull referral link below the video. If you sign up for an account, deposit $100, you get a free stock, I get a free stock, everybody wins. Also, if you enjoyed the video today, please like the video, subscribe to the channel, and if you want to be alerted to all my content as soon as it goes live, make sure you hit that notification bell. All right, everybody, thanks a lot. Stay safe. Good luck investing. I'll see you soon.